Welcome everyone, my name is Jason Weaver. I'm the managing partner with Weaver Consulting Group, a local registered investment advisor practice here in Huntington Beach, California. Thank you for joining us for 3 and 3. Today we're going to be talking about a barbell strategy, minimum volatility, and treasury bonds. A barbell strategy. A barbell strategy is when you have assets on both sides of the spectrum. So you have your risk assets and your risk off assets. And there's nothing really in between. We typically use this portfolio strategy when we expect potentially more volatility or some type of crash of some sort. You have your safe assets on one side, which again would typically include short-term treasury bonds, cash and CDs. On the other side are your risk assets, stocks and growth positions. In the middle, you really have nothing. So you would be avoiding high-yield bonds or something of that sort. Minimum volatility. So minimum volatility stocks try to get some type of stock market return similar to like the S&P 500 with potentially less risk. Typically they'll put those baskets together, and these are baskets that typically include stocks that have more stable prices, like healthcare stocks, utilities, or again, consumer staples. And as you see a stock market like 2018, which is extremely volatile, and you follow the pink line, which is the minimum volatility stocks, and compare that against the orange line, which is the S&P 500, typically you're going to get less of a valley, and again, less of a peak. And over a period of time, when there's a lot of volatility like you're seeing here, usually those stocks will outperform because the highs are not as high and the lows are not as low. And that happened in 2018. We're not sure what's going to happen in 2019, but if we start experiencing that volatility again, this would be a great strategy to deploy in your portfolio. Treasuries. So treasuries, again, are typically called government securities. They're backed by the full faith and credit of the U.S. government because they can raise taxes in order to pay that debt. Again, they're a great security to use in volatile periods of time or when you're nervous about the stock market. As you're looking at here, this is a little bit confusing, but follow the line down here, which is looking at the Fed fund rate. And what the Fed fund rate does is as they raise that rate, short-term treasury bonds start actually paying more interest. And as you can see, short-term treasury bonds, in comparison to a 10-year or 30-year treasury bond, have about 80 to 90% of the yield of those long-term securities. Now might be a great time to start using short-term treasury bonds as a risk-off asset in your portfolio. Thank you again for joining us for 3 and 3.